Director of Investment Management with Argent Bridge Advisors, and this is Cup of Joe. We've got kind of a mixed bag today, and we're going to jump around a little bit to try and hit some quick lessons in investing and economics based on the things that are going on currently. And to start us out, I have a rhetorical question for you. If you're on a team whose star player scores all the points, what happens when that player gets hurt or leaves? If you don't know, just ask the New England Patriots after Tom Brady left. Haha. But no, the real answer is that all the other players on the team need to step up and perform. And we're seeing a little bit of that going on in the markets this year. Asset allocation has been a big factor this year. We're seeing a big benefit of being diversified in your portfolio. What is illustrated here is a pretty vanilla portfolio of several different asset classes, 60% in stocks, 40% in bonds. And we can see that that diversified portfolio has held its own as far as upside performance next to the S&P 500, but also with about half as much downside through the correction in April. So that was a very good development beyond such the concentrated indexes we've seen over the past about 2 years. Now, staying with portfolio performance, our second illustration has to do with performance relative to risk. Your portfolio performance is largely driven by your strategic allocation. Your strategic allocation is your target balance of stocks and bonds and cash that your Argent Bridge advising team sets with you based on your time horizon, your growth needs, and your appetite for risk. Now, what you see here is the performance this year of 3 different strategic allocations. That one with 40% bonds, another one with 25% bonds, then a third one with no bonds. This is an all stock allocation, all in various asset classes. This includes small caps, mid caps, internationals, emerging markets, some real assets. And you can see the different performance this year. They've each achieved different levels of upside performance, but they also had substantially different downside performance when the market dipped back in April. So our investment committee worked very hard to try and find great performing strategies and put those to good use for everyone as the weather forecast changes. But just keep in mind that your portfolio performance is primarily driven by your strategic allocation. And please remember that when you go to compare what you have to some arbitrary benchmark. Okay, we're going to switch gears for a minute and talk about something that we have been hearing lots about recently and in about the past month or so, and that is the Fed. So the Fed has a meeting coming up this week, and by the time this comes out, they may have already met. And they meet about 6 times a year usually to set interest rates. Now, what is the Fed trying to do here? Well, when the Fed was created a long time ago, they were given 2 tasks: try to achieve maximum employment or full employment and keep prices stable. So trying to make sure that as many people as possible are employed. This target of full employment, and to do this, they may need to lower interest rates because that spurs borrowing and increases economic activity, which in turn increases demand for workers. Now, the second mandate, try to keep prices stable. Said another way, they're trying to keep inflation down at a reasonable rate, which historically they've targeted about 2% annually. So this mandate is to control prices of goods and services so that consumers continue to spend and feed the economic cycle. Now, to do this, to keep prices under wraps, the Fed may need to raise interest rates. This will decrease economic activity. A knock-on effect of this is that when interest rates go up, savings vehicles become more attractive to individual investors. So people are spending less generally because they're saving more. So all these things together has the total effect of pulling prices down. So with these 2 mandates, here we are with the Fed's current quagmire. And that is that right now, the unemployment rate is starting to tick up. But the economic data rolling out is also telling us that there's upward pressure on inflation. So they have these two dueling mandates that are both going up, and they need to try and reverse those. Now, how does this affect you? Well, they could lower rates, which may boost the stock market, and that'll boost your portfolios. They're lowering rates to try and keep the unemployment rate under control. But if inflation starts accelerating, they need to raise interest rates. That would be good for you because it would eventually lower prices, but that usually comes at an economic cost and takes a little time. So if you were on the Fed, what would you do? It's tough. All right. And finally today, I want to talk about the stock market itself. And what we're talking about is that the US stock market, there's a pretty wide consensus that stock prices right now are pretty expensive. And there's a few indicators of these. First is the fact that we now have multiple trillion-dollar companies, companies whose market cap is up over $1 trillion. And I think at last count, there was 10. Most of these are humongous tech companies, and the expectations for these companies have just been built up so much, especially because of the AI industry and the explosion there. But these companies just keep delivering. And every time they do, it springboards these prices even more. So this has become a problem that's actually compounding on itself. A very good recent example of this is Oracle. Last week, Oracle reported earnings. They beat earnings, which was good, but they also gave guidance that they've made lots of headway into AI, and that's going to be that is going to add to their future revenue growth coming up. Well, the market went nuts for this, and the stock price went up over 40% in one day. This was a company that was already worth about $685 billion, and it rallied 40% in a couple hours. Now, if that doesn't sound like a frenzied environment, then I'm not sure what does. And the term frothy comes to mind because that's been used in the past when market participants kind of get out over their skis. But this is not unique to tech. If we look at the forward-looking price to earnings ratio, which is a very commonly used measure of valuation, if we look at that measure for every sector in the S&P 500, we see that they are all above their 20-year average. Actually, except for real estate, which is right at its 20-year average, but everything else is above. And the index as a whole is about 38% above its 20-year average. So things are expensive across the board. There's no doubting that. So what does this mean? Well, it just means that we should expect drawdowns, expect some volatility. Don't be surprised if we experience a correction, which could be slow and gradual, or it could be fast and furious, but conditions are right. So it's prudent to expect that and not be surprised when it does. And if/when it does, being diversified should help then as well. So this has certainly been a very busy year with a completely different playbook. And in a weird year like this, trying to be too clever, that's how you get caught off sides. And that usually does your portfolio a disservice. So I hope the things we talked about today bring you clarity about what's going on right now. If you have any questions at all, please reach out to anyone at our Argent Bridge, and we are very happy to help. That does it for this month's Cup of Joe. Be sure to like this video. Be sure to subscribe to our YouTube channel. Have a wonderful day.